Hi, and welcome to another episode of A Smarter Way to Retire, the podcast where we break down the steps to building a confident and smart retirement plan. I'm Tony Leonardi, your CFP professional, and I'm thrilled to be with you today. Here we are in the middle of May already. Time is really flying. Over the past few weeks, the news has been heavy, filled with economic uncertainty and market volatility that's left many of us, including some of my clients, feeling a bit rattled, to say the least. Headlines have been screaming about stock market dips and investor panic, and it's easy to get caught up in all that noise. But here's the thing. Reacting to headlines alone can steer us off course. As financial planners, we know the real story lies in the data, not in the drama. Today, I want to shift the focus to some refreshing developments that have emerged this past week. We've seen 3 positive economic updates that are turning heads and lifting spirits and stock markets. First, the UK signed a new trade deal with the US, the first major country to do so. Second, the White House announced a favored nation status for pharmaceuticals, aiming to align U.S. drug prices with global rates. And third, the U.S. and China have inked a new trade deal. These stories are breathing new life into the markets, and while they might not mean we're fully out of the volatility woods, there's certainly a reason to pause and take a deeper look. So grab a cup of coffee, settle in, and let's dive into these developments together. We'll explore what they mean, why they matter, and how you can use this information to stay grounded in your retirement planning. So let's get started. For our first topic, let's talk about the exciting news of a new trade deal between the US and the UK. This week, the UK became the first major country to sign a trade agreement with the US under the current administration, and it's a big deal. This deal, which builds on years of economic ties between the two countries, is designed to boost trade in key sectors like agriculture and manufacturing and technology. For the US, it opens up a $5 billion market for American farmers and businesses, while the UK gains better access to US goods and services. The timing couldn't have been any better. After weeks of tariff tensions and market jitters, this agreement may signal a return to stability and cooperation, and encourage more countries to come to the table to negotiate their own trade deals. Now, you might be wondering how this affects your retirement or investment portfolio. Trade deals like this can stimulate economic growth, which often lifts stock markets. We've already seen a positive response with sectors like manufacturing and retail showing gains. For my clients, this is a reminder that global partnerships can create opportunities even in uncertain times. But here's the key. Don't let the headline euphoria drive your decisions. Look at the data. Check the performance of companies involved, like those in the S&P or the FTSE 100, and see how they align with your investment strategy. Do you have any international exposure? Many investment managers have been avoiding international stocks for some time now. Maybe it's time to add or adjust your international allocation. Talk to your advisor. Volatility might still linger, but this deal suggests a foundation for recovery. As retirees or those planning for retirement, the bigger picture is about diversification. A stronger US-UK trade relationship could mean more resilient markets, but it's not a cure-all. Take a moment to review your asset allocation with your advisor. Ensure that you're balanced across sectors and geographies. This deal is a step forward and it's worth celebrating, but let's keep our eyes on the long-term data rather than the short-term buzz. Next up, let's dive into a development that's hitting close to home for many of us. The White House's announcement of a favored nation status for pharmaceuticals. On May 12th, the administration revealed plans to align U.S. prescription drug prices with those of other countries, adopting a most favored nation policy. This means the U.S. will pay rates comparable to the lowest prices negotiated globally, potentially cutting costs by 30 to 80% here in the U.S. For retirees on fixed incomes, this could ease the burden of healthcare expenses, a major concern for many of my clients. What makes this move so noteworthy isn't just the policy itself, but the bipartisan support behind it. Democrats like Senator Bernie Sanders have been calling for this type of price relief in pharmaceuticals for years, arguing that Americans shouldn't pay more for the same drugs compared to countries like Canada or Germany, for instance. Sanders has championed this since at least 2015, often pointing out that the U.S. pays up to 3 to 4 times more for medications than other developed nations. The current administration, despite its conservative leanings, echoed this sentiment with the executive order signed this week, directing the Department of Health and Human Services to enforce these price reductions. Pharmaceutical companies now have a month to comply or face stricter regulations. It's a rare moment of agreement in a politically contentious time, proof that even in the most divided climate, we can still get things done for the American people when there's common ground. Now, let's put this into perspective with some real-world examples. Take Ozempic, for example, a popular drug used to manage diabetes and support weight loss. It's been a game changer for many. In the US, the list price for a month's supply of Ozempic has hovered around $935. That's according to a recent data study from Novo Novartis, the manufacturer. That's almost $1,000 per month for weight loss pills. I would argue that a gym membership might be a better use of your money and better for your health, but that's a subject for another day. Compare that to Canada, where the same drug costs about $200 per month, or Germany, where it's closer to $150. That's a staggering difference, up to 6 times more here in the US. Another example is Humira, a widely prescribed drug for arthritis, which costs around, ready for this, $7,000 per month in the US, while in the UK it's available for under $1,000. These disparities have fueled the push for this policy, and it's no wonder retirees have felt the pinch. The stock market reacted positively this week to the news with a rally, yes, a rally in healthcare stocks, as investors see this as a win for consumers without completely derailing industry profits. These big pharma companies will still make their profits, but the profit will be spread more evenly around the world. So what does this mean for you? Lower drug costs could free up more of your retirement income for other goals, travel, hobbies, or even bolstering your savings. For my clients on medications like Ozempic or Humira, this could mean hundreds or even thousands saved annually, depending on the dosage. But let's not get carried away with the headlines again. The policy is still in its early stages, and implementation details are unclear. Check the financial data. Look at how pharmaceutical giants like Pfizer or Johnson & Johnson are performing, and consider how healthcare costs factor into your budget. For my clients, I recommend revisiting your retirement income plan to see if this shift impacts your healthcare allocations or your probability of success. Remember, long-term probability of success is the goal, not short-term headline-driven moves. This is a hopeful sign, especially after weeks of economic gloom. It's a reminder that bipartisan efforts can yield policies that benefit everyone. And these examples show just how much relief could be on the way. But staying informed with data rather than headlines will keep you steady through any remaining volatility. Finally, let's turn to the big news out of Geneva. The US and China have signed a new trade deal. Announced on May 12th, this agreement temporarily slashes tariffs, with the US reducing rates from 145% down to 30% on Chinese goods, and China dropping from 125% down to 10% on U.S. imports. This is effective for 90 days while talks continue. This de-escalation could end a trade war that has stalled nearly $600 billion in bilateral trade. And the stock market responded with a surge, lifting indices like the S&P 500 to their highest levels since early March. This deal could be a game changer. It addresses not just tariffs, but also issues like fentanyl, technology, semiconductors. And this is signaling a reset in U.S.-China relations. For investors, this means potential growth in sectors hard hit by the trade war. Think tech giants like Nvidia or retail stocks that rely on global supply chains like Amazon. My clients have expressed relief, especially those with exposure to international markets, but there's still uncertainty about a permanent agreement. So here's what we need to focus on: the data, not the headlines. This deal has sparked a relief rally, but volatility could return if negotiations falter. Review your portfolio. Look at how your investments in tech or manufacturing have performed since Monday's announcement. Diversification remains the key. And for retirees, this could mean opportunities to rebalance or lock in gains. It's refreshing to see this progress, and while it doesn't guarantee smooth sailing, it's a strong signal that global cooperation can stabilize markets. Personally, I'm a little surprised that this happened so fast. I wasn't expecting any deal with China to happen for at least several months. This tells me that maybe China's economy is really feeling the tariff pinch, causing President Xi to come to the table earlier than expected. Or maybe this is a chess move by China to relieve some pressure temporarily. I'd keep a close eye on this. Either way, as we navigate these challenges and these changes, lean on your financial plan rather than reacting to every news cycle. This U.S. deal, alongside the U.K. agreement and pharmaceutical policy, offers a brighter outlook. But it's the numbers that will guide us forward. If you're ever feeling uncomfortable, go back to your plan, review your probability of success meter. I've done this with several clients over the past few weeks. I think it's safe to say that everyone has been relieved to see that they're still in pretty good shape for the long run, despite the constant negative analysis on the news. Remember, it's the job of the news stations to get ratings. It sort of reminds me of that Don Henley song from 1982, Dirty Laundry, where he sang about the media's love for bad news. And that was over 40 years ago. So not much has changed. Remember the bubble-headed bleach blonde who comes on at 5? She can tell you about the plane crash with the gleam in her eye. That song nailed how headlines thrive on drama. And lately we've seen that play out with stories of stock market dips and investor panic. The difference today is that bleach blonde, to use Don Henley's term, doesn't come on at 5 anymore. She's on 24/7. Dishing out dirty laundry all day and night. I know that I have clients that have those 24/7 news stations on the TV all day at home. Whether it's Fox or CNN or any other channel, you can get overwhelmed with negative ratings grabbing news if you're not careful. It's easy to get caught up in the noise, but we know better, don't we? My advice, turn off the news for 23 hours a day. You can get all the news you need in 1 hour. It's springtime. Go outside, plant some flowers, start a garden, grow some vegetables. Take your shoes off, put your bare feet in the grass. Isn't this exactly where the term feeling a bit more grounded comes from? Think about it. Breathe in the fresh air, and don't forget to get some exercise. You'll feel much better physically and mentally. Well, that wraps up today's episode of A Smarter Way to Retire, and I hope you're feeling a bit more grounded after this discussion. We've weathered weeks of negative news and market volatility, and it's been tough not to feel the weight of those headlines. But this week's 3 positive developments, the UK-US trade deal, the White House's pharmaceutical favored nation status, and the US-China trade agreement, offer a glimmer of hope. They've lifted stock markets, eased some economic pressures, and reminded us that progress is possible even in uncertain times. For my clients and prospects, here's the takeaway. These stories are encouraging, but they're not a full escape from volatility. The market's rally is real, driven by data like the S&P 500's rise and sector gains in tech and healthcare, but it's the long-term picture that matters. I encourage you to tune out the noise and tune into your financial plan. Review your investments with your advisor. Assess how these developments affect your income sources or healthcare costs, and stay diversified. Tools like Money Guide Pro, which we use in my practice, can help us measure your probability of success, adjusting as needed, just like step 10 of our journey outlined in my book, A Smarter Way to Retire. You're not alone in this. I'm here to help you navigate these shifts, whether it's rebalancing your portfolio or exploring the new opportunities that these deals might bring. For more resources, visit LeonardiFamilyWealthCare.com, where you can download our 2025 Retirement Reset Checklist. Thanks for joining me today. Let's keep building that smarter retirement together. Until next time, stay informed, stay steady, and take care.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.